They say investing is about conviction, about believing in your ideas and staying the course. They are wrong. Conviction without a statistical foundation is not strategy. It is gambling dressed in confidence. I have watched for decades as intelligent people, successful in their fields, approach markets with frameworks that are mathematically unsound. They optimize for feelings rather than outcomes. They confuse narrative coherence with predictive power. And they fail, not because they lack intelligence, but because they operate without understanding the underlying probability distributions that govern all financial systems. If you are about to invest another dollar, stop. What I'm going to share with you is not a tip, not a hot stock, not a secret algorithm. It is a framework, a system of thinking that separates those who survive market cycles from those who are destroyed by them. This is about structure, about building a decision-making architecture that functions independently of emotion, news cycles, and the crowd's delusions. The principles I will outline are the result of applying rigorous quantitative discipline to chaotic systems. If you follow them, you will not eliminate risk. That is impossible. But you will transform risk from an unknowable enemy into a measurable, manageable variable. Before we continue, if this approach to understanding markets through mathematics and discipline resonates with you, subscribe now. The insights that follow require focus, and I will not repeat them. This is not entertainment. This is education for those serious about long-term capital preservation and growth. Let me start with a simple truth that most investors refuse to accept. The market does not care about your analysis. It does not care about your research, your conviction, or how many hours you spent building your thesis. The market is a collective expression of human behavior, and human behavior, when observed at scale, follows patterns that are statistically predictable. Not perfectly predictable, not deterministically predictable, but predictable enough that a disciplined system can exploit the gaps between rational pricing and actual pricing. The first error most investors make is believing that more information leads to better decisions. This is false. More information often leads to overconfidence. You gather data, you build a story, and that story feels coherent. The coherence makes you believe you understand what will happen next. But coherence is not the same as accuracy. Perfectly logical narrative can still be wrong because the variables you did not consider, the tail events you dismissed as improbable, the second-order effects you ignored. These are often the forces that determine outcomes. What you need is not more information. What you need is a system that accounts for what you do not know. That system must have three characteristics. First, it must define risk mathematically, not emotionally. Second, it must be robust to uncertainty, meaning it survives even when your assumptions are wrong. Third, it must be unemotional in execution, removing the human tendency to override logic with fear or greed. Let us address the first characteristic, defining risk mathematically. Most people define risk as the possibility of losing money. That is incomplete. Risk is the probability-weighted distribution of all possible outcomes, not just the negative ones. When you make an investment, you are not making a single bet. You are entering a probability space where many futures exist simultaneously until the outcome is realized. Your job is not to predict which future will occur. Your job is to ensure that across all probable futures, your position survives and ideally profits. This requires understanding volatility, not as a number on a chart, but as the mathematical measure of uncertainty. Volatility tells you how wide the range of possible outcomes is. When volatility is low, the system is stable. Outcomes cluster near the mean. When volatility is high, the system is unstable. Outcomes spread out, and the tails, the extreme events, become more likely. Most investors treat low volatility as safe and high volatility as dangerous. This is backward. Low volatility often precedes the largest shocks because it breeds complacency. High volatility, if managed correctly, is where opportunities exist because prices overshoot in both directions. The error is conflating volatility with risk. Volatility is the environment. Risk is your exposure relative to that environment. If you are over-leveraged in a high volatility environment, you are fragile. If you are under-leveraged in a low volatility environment, you are missing opportunity. The goal is to match your position size, your capital allocation to the statistical regime you are operating in. That is not intuition, that is calculation. Now let us move to the second characteristic, robustness to uncertainty. This is where most systems fail. They are optimized for a specific scenario. They work beautifully when conditions match assumptions. But the moment reality diverges, and it always does, the system collapses. A robust system is one that does not depend on being right about any single variable. It is diversified not just across assets, but across assumptions. Consider a simple example. You believe interest rates will remain low, so you construct a portfolio that profits from low rates. That is a bet. If rates rise unexpectedly, your portfolio suffers. A robust approach would ask, what happens if I am wrong? It would then allocate a portion of capital to positions that benefit from rising rates, not because you expect rates to rise, but because you acknowledge the possibility. This is not hedging in the traditional sense. It is a structural diversification of assumptions. The mathematical principle here is non-correlation. When you hold assets that are correlated, meaning they move together, you are amplifying your exposure to a single underlying factor. If that factor moves against you, everything moves against you. True diversification means holding positions that respond to different drivers. Equities respond to growth expectations. Bonds respond to interest rates and credit risk. Commodities respond to supply and demand dynamics. Real assets respond to inflation and currency debasement. By holding a mix, you ensure that no single shock destroys you. But robustness goes deeper. It also means building in redundancy. Redundancy is an efficiency by design. It is the opposite of optimization. An optimized portfolio squeezes out every basis point of return. A robust portfolio leaves room for error. That room is your cash reserve, your liquidity buffer, your safety margin. It is the difference between a bridge built to hold exactly the expected load and a bridge built to hold 3 times that load. The second bridge costs more, it is less efficient, but it does not collapse. This brings us to the third characteristic on emotional execution. This is where discipline separates the professional from the amateur. You can have the best mathematical model in the world. You can understand probability distributions, correlations, and tail risk. But if you cannot execute your system when it is telling you to do something that feels wrong, you will fail. Markets are designed to exploit human psychology. They rise when fear is highest, trapping those who sold at the bottom. They fall when greed is highest, trapping those who bought at the top. The emotional investor is always one step behind because they are reacting to feelings, not data. The quantitative investor follows a predefined set of rules. Those rules are executed regardless of how they feel. Let me give you a concrete example. Suppose your system signals that a market correction has reached a threshold where assets are statistically cheap. The news is terrible. Pundits are predicting collapse. Your peers are selling. Every instinct tells you to wait. But your system says, buy. What do? The amateur waits. They rationalize. They find reasons to override the signal. The professional buys. Not because they are brave, but because they trust the mathematics more than they trust their emotions. This is why systematic trading works. It removes the human from the decision loop. The system does not feel fear. It does not feel greed. It simply evaluates probabilities and executes. If you are building a manual investment process, you must replicate this discipline. Write down your rules in advance. Define your entry points, your exit points, your position sizes, your rebalancing triggers. Then follow them without deviation. Now let us address a deeper issue, the illusion of control. Most investors believe they are in control of their outcomes. They make a decision, they execute, and they wait for the result. But in reality, you control almost nothing. You do not control market prices. You do not control economic policy. You do not control geopolitical events. The only thing you control is your own behavior, your process, your adherence to a system. This is a profound shift in mindset. It means accepting that even perfect decisions can lead to losses. Why? Because investing is probabilistic, not deterministic. A decision that has a 70% probability of success will still fail 30% of the time. That does not mean the decision was wrong. It means the outcome was unlucky. The key is to make decisions that have positive expected value and to repeat those decisions enough times that the law of large numbers works in your favor. This is the essence of quantitative thinking. You are not trying to be right on every trade. You are trying to be right on average. Over hundreds or thousands of decisions, the edge compounds. Individual losses become noise. What matters is the aggregate. That is why position sizing is so critical. If you bet too much on any single outcome, a single loss can wipe you out before the law of large numbers has a chance to work. If you bet too little, your edge does not generate meaningful returns. The correct position size is a function of your edge and your tolerance for drawdown. Let me introduce a concept that most investors misunderstand: expected value. Expected value is the probability-weighted average of all possible outcomes. If you have a 60% chance of making $10 and a 40% chance of losing $5, your expected value is positive. 60% times 10 minus 40% times 5 equals $4. On average, over many iterations, you will make $4 per trial. That is a positive expected value trade. But here's where most people fail. They take one trial, they lose $5, and they conclude the trade was bad. They do not understand that a single outcome tells you nothing about the quality of the decision. What matters is whether the decision repeated many times generates a positive return. This is why casinos win. They do not win every hand. They win on average. Their games have a small negative expected value for the player and a small positive expected value for the house. Over millions of hands, that small edge compounds into certainty. You must think like the house, not like the player. The player hopes to get lucky. The house knows that probability will prevail. In investing, you are the house if you have a system with positive expected value and you execute it consistently. You are the player if you are chasing returns, reacting to emotions, and hoping for luck. Another critical concept is the difference between risk and uncertainty. Risk is measurable. It is the known distribution of outcomes. You can calculate the probability of a stock moving within a certain range based on historical volatility. Uncertainty, on the other hand, is unmeasurable. It is the unknown unknowns, the events that have never happened before and therefore have no historical data to model. The mistake most investors make is treating uncertainty as if it were risk. They build models based on historical data and assume the future will resemble the past. But financial systems are non-stationary. The rules change. The distributions shift. What worked in one regime may fail in another. This is why stress testing is essential. You must ask, what happens if the correlations break down? What happens if volatility spikes to levels not seen in the historical data? What happens if liquidity disappears? A robust system is one that survives uncertainty, not just risk. It does not depend on the past repeating itself. It is designed to function even when the unexpected occurs. This is where diversification, liquidity buffers, and leverage constraints become critical. They are the structural safeguards that allow the system to withstand shocks that were not explicitly modeled. Let me now address leverage, because this is where most investors destroy themselves. Leverage amplifies returns, but it also amplifies risk. More importantly, it transforms temporary losses into permanent ones. If you are unleveraged and an asset falls 20%, you still own the asset. You can wait for recovery. If you are leveraged and the asset falls 20%, you may face a margin call. You are forced to sell at the worst possible time, locking in the loss. The mathematics of leverage are nonlinear. A 50% loss requires a 10% gain to recover. If you are leveraged 2 to 1, a 25% loss in the underlying asset wipes out 50% of your capital. A 50% loss wipes you out completely. The more leverage you use, the smaller the margin of error. This is why professional quantitative funds use leverage conservatively and pair it with rigorous risk management. They know that leverage is a tool that can destroy you if misused. For individual investors, my recommendation is simple. Use no leverage, or use it sparingly, and only when you have a clear edge and a well-defined stop loss. Never use leverage to amplify a hope or a hunch. Use it only when the probabilities are overwhelmingly in your favor and the downside is tightly controlled. Now let us turn to the concept of time horizon. Time is one of the most powerful variables in investing, yet most people mismanage it. They confuse short-term volatility with long-term risk. They panic during drawdowns because they are measuring performance over days or weeks when they should be measuring it over years or decades. The mathematics are clear. Over short time horizons, markets are dominated by noise. Prices fluctuate based on sentiment, liquidity, and technical factors that have little to do with fundamental value. Over long time horizons, fundamentals reassert themselves. Companies that generate cash flow are valued. Assets that preserve purchasing power appreciate. The noise averages out. This is why a long time horizon is such a powerful advantage. It allows you to ignore short-term fluctuations and focus on long-term probabilities. It also allows you to exploit the fact that most market participants are short-term oriented. When they panic and sell during a temporary downturn, you can buy. When they euphoric and buy at the top, you can sell. You are playing a different game, one where time is your ally, not your enemy. But having a long time horizon is not the same as being passive. It does not mean buy and hold blindly. It means having the discipline to wait for high probability opportunities and the patience to let them play out. It means rebalancing systematically, not emotionally. It means harvesting gains when assets are overvalued and adding exposure when they are undervalued. Let me now discuss the role of liquidity, because this is one of the most underappreciated aspects of risk management. Liquidity is not just about being able to sell an asset quickly. It is about being able to act when opportunities arise. A portfolio that is 100% invested in liquid assets is a portfolio without optionality. You cannot pivot. You cannot take advantage of dislocations. You are locked in. This is why cash, despite earning low returns, is a strategic asset. Cash is optionality. It is the ability to act when others cannot. During a market crash, when everyone else is forced to sell to meet margin calls or redemptions, the investor with cash can buy at distressed prices. That cash position, which seemed like a drag during the bull market, becomes the most valuable asset in the portfolio during the crisis. The mathematics of liquidity are nonlinear. In normal times, illiquidity is rewarded. You earn a premium for locking up your capital. But in times of stress, illiquidity is punished. You cannot exit when you need to. You are forced to accept whatever price the market offers, if there is a market at all. A robust system maintains a liquidity buffer precisely for these moments. It sacrifices some return in normal times to ensure survival in extreme times. Another principle that is often overlooked is the importance of rebalancing. Rebalancing is the systematic process of bringing your portfolio back to its target allocation. It sounds simple, but it has profound implications. When you rebalance, you are selling assets that have outperformed and buying assets that have underperformed. This feels wrong. It feels like you are giving up winners and adding to losers. But mathematically, it is correct. Why? Because asset prices tend to revert to the mean over time. What has outperformed is often overvalued. What has underperformed is often undervalued. By rebalancing, you are systematically buying low and selling high, not based on market timing or forecast, but based on a mechanical rule. This removes emotion from the process and ensures that you are always leaning against the prevailing trend, which is where the edge exists. The frequency of rebalancing matters. Rebalance too often, and you incur transaction costs and taxes without gaining much benefit. Rebalance too infrequently, and your portfolio drifts away from its target allocation, exposing you to unintended risks. The optimal frequency depends on your specific situation, but a quarterly or annual rebalance is often sufficient for most investors. Now let us address the concept of tail risk. Tail risk refers to the probability of extreme events, events that lie in the tails of the distribution far from the mean. These are the events that standard models often underestimate because they are rare. But rare is not the same as impossible. And when tail events occur, they dominate outcomes. The 2008 financial crisis was a tail event. The pandemic market crash in 2020 was a tail event. These events were not predicted by most models because they fell outside the range of historical experience. But they happened, and they wiped out investors who were not prepared for them. Rava's system must account for tail risk. This does not mean predicting specific tail events. That is impossible. It means structuring your portfolio so that you survive them when they occur. This is where diversification, liquidity buffers, and avoiding excessive leverage become critical. These are the structural features that ensure you are still in the game after the tail event has passed. One way to think about tail risk is through the lens of asymmetry. Most investments have limited upside and significant downside. You can lose 10% of your capital, but you can only gain a finite multiple. This is a bad asymmetry. What you want are investments with limited downside and significant upside. These are asymmetric bets, and they are the foundation of long-term wealth creation. Options are one way to create asymmetry. A call option has limited downside, the premium you pay, and unlimited upside. But options are expensive and time-sensitive, so they are not always practical. A better way for most investors is to build asymmetry into the portfolio structure itself. Hold a diversified portfolio with a liquidity buffer. That buffer limits your downside by giving you the ability to act during crashes. The upside is unlimited because you can deploy that buffer into distressed assets. Let me now turn to a topic that is often ignored: taxes. Taxes are a drag on returns, and they are one of the few variables you can control. Yet most investors do not optimize for tax efficiency. They trade frequently, generating short-term capital gains that are taxed at ordinary income rates. They hold assets in taxable accounts that could be held in tax-advantaged accounts. They fail to harvest losses to offset gains. A disciplined investor treats taxes as a cost to be minimized, not an afterthought. This means holding assets for longer than 1 year to qualify for long-term capital gains treatment. It means using tax-advantaged accounts for investments that generate ordinary income. It means systematically harvesting tax losses to offset gains. These are not complex strategies, they are mechanical. Rules that applied consistently can add significant value over time. Another often overlooked factor is fees. Fees, like taxes, are a direct drag on returns. A 1% annual fee may not seem like much, but compounded over decades, it can reduce your terminal wealth by 20% or more. This is why passive index funds have become so popular. They offer broad diversification at a fraction of the cost of active management. But low fees are not the only consideration. What matters is net return after fees. If an active manager charges 1% but delivers 2% of outperformance after fees, they are worth it. The problem is that most active managers do not consistently deliver outperformance. The data is clear. The majority of active managers underperform their benchmarks over long time horizons. This is not because they are incompetent. It is because the market is competitive and any edge is quickly arbitraged away. For most investors, the rational choice is to accept market returns at low cost rather than chase outperformance at high cost. This is not exciting. It is not glamorous, but it is mathematically sound. And over a lifetime, it compounds into significant wealth. Now let us discuss the psychological barriers that prevent most investors from following a disciplined system. The first is overconfidence. Most people believe they are above average. This is a statistical impossibility, yet it is a pervasive bias. Overconfidence leads to excessive trading, concentrated positions, and underestimation of risk. The antidote is humility. Recognize that the market is smarter than you. Recognize that your edge, if you have one, is small and temporary. Act accordingly. The second barrier is loss aversion. Losses hurt more than gains feel good. This is hardwired into human psychology. It causes investors to hold losing positions too long, hoping for recovery, and to sell winning positions too early, locking in gains. The antidote is to reframe losses as information, not pain. Loss tells you that your thesis was wrong or that the market disagreed with you. It is data. Use it to update your model, not to torture yourself emotionally. The third barrier is recency bias. Recent events loom larger in our minds than they should. If the market has been going up, we expect it to continue going up. If it has been going down, we expect it to continue going down. This causes us to buy high and sell low, the exact opposite of what we should do. The antidote is to rely on statistical models, not intuition. Models are not influenced by recency. They evaluate probabilities based on the full distribution of outcomes, not just the most recent ones. The fourth barrier is the illusion of knowledge. The more information we have, the more confident we feel, even if that information does not improve our predictions. This is dangerous because it leads to overtrading and overconfidence. The antidote is to recognize that most information is noise. Focus on the variables that actually matter, ignore the rest, and build a system that is robust to the noise. Let me now address a question that many investors ask. How do I know if my system is working? The answer is that you cannot know based on short-term results. A good system can have long periods of underperformance. A bad system can have long periods of outperformance due to luck. What you need is a way to evaluate the system independently of its recent results. One way to do this is through backtesting. Take your system, apply it to historical data, and see how it would have performed. This gives you a sense of its expected return, its volatility, its maximum drawdown, and its behavior in different market environments. But backtesting has limitations. It assumes the past is representative of the future, which is not always true. It also suffers from overfitting. You can design a system that works perfectly on historical data but fails in real time because it was optimized to that specific data set. A better approach is to combine backtesting with forward testing. Run your system on historical data to develop it, then test it on out-of-sample data that was not used in the development process. If the system performs well on out-of-sample data, it is more likely to perform well in real time, but even this is not a guarantee. The only true test is live performance over many years and many market cycles. Another way to evaluate a system is through its theoretical foundation. Does it make sense? Is it based on a principle that is likely to persist? For example, A system based on mean reversion has a theoretical foundation. Prices tend to revert to fair value over time. A system based on chasing momentum has a theoretical foundation. Trends tend to persist in the short term due to behavioral biases. A system based on a random pattern in historical data has no theoretical foundation. It is likely to fail because the pattern was noise, not signal. Now, let us turn to the concept of adaptation. Markets change. What works in one environment may not work in another. A disciplined system must be adaptive, not rigid. But adaptation does not mean changing your system every time it underperforms. That is overreacting to noise. Adaptation means updating your system based on new information or structural changes in the market. For example, if a new regulation changes the way a market functions, your system may need to account for that. If correlations between assets shift permanently, your diversification strategy may need to adjust. But these changes should be deliberate and based on evidence, not on short-term performance or gut feelings. One way to build adaptability into a system is to use multiple models or strategies. If one model stops working, others may continue to work. This is diversification at the strategy level, not just the asset level. It reduces your dependence on any single approach and increases the robustness of your overall system. Let me now address the role of technology in modern investing. Technology has transformed markets. It has increased speed, reduced costs, and democratized access to information. But it has also increased competition. The edges that existed in the past have been arbitraged away by algorithms that trade faster and more efficiently than humans ever could. For individual investors, technology is both an opportunity and a challenge. The opportunity is that you can now access tools and data that were once available only to institutions. You can backtest strategies, analyze portfolios, and execute trades at low cost. The challenge is that you are competing against algorithms that are better, faster, and more disciplined than you are. The solution is not to try to compete with the algorithms on their own terms. You cannot. The solution is to focus on what you can control, your time horizon, your discipline, your willingness to hold through volatility. These are advantages that algorithms do not have. They are designed to maximize short-term efficiency. You can optimize for long-term survival. Another important point is that technology has increased the speed of information flow. News that would have taken days to spread now spreads in seconds. Prices adjust almost instantaneously. This means that by the time you hear about a news event, it is already priced in. Trying to trade on news is almost always a losing strategy because you are late. The only way to profit from news is to anticipate it before it happens, which is extremely difficult, or to ignore it entirely and focus on long-term fundamentals. Let me now discuss the concept of compounding, because this is the most powerful force in investing. Compounding is the process by which your returns generate further returns. It is exponential growth. That was 10% annual return does not double your money in 10 years. It increases it by 159%. Over 30 years, it increases it by 645%. The longer the time horizon, the more powerful compounding becomes. But compounding works in both directions. Losses also compound. A 10% loss requires an 1% gain to recover. A 50% loss requires a 100% gain to recover. This asymmetry is why protecting capital is so important. Every loss sets you back more than an equivalent gain moves you forward. The key to harnessing compounding is to avoid large losses. If you can protect your downside and generate consistent, moderate returns, compounding will do the rest. This is why a boring disciplined system often outperforms a flashy high-risk system over the long term. The flashy system may have higher returns in good years, but it also has larger drawdowns. Those drawdowns interrupt compounding and set you back years. Let me give you a concrete example. Investor A earns 15% per year on average, but experiences a 50% drawdown every 10 years. Investor B earns 10% per year on average, with a maximum drawdown of 20% over 20 years. Who comes out ahead? The answer is Investor B. Why? Because the large drawdowns suffered by Investor A interrupt compounding. The time spent recovering from those drawdowns is time not spent compounding. Investor B, with more consistent returns, compounds steadily and ends up with more wealth. This is the power of consistency over volatility. It is not about maximizing returns. It is about maximizing risk-adjusted returns. And the best way to do that is to avoid large losses. Now let me address the concept of market timing, because this is one of the most seductive and dangerous ideas in investing. Market timing is the attempt to predict when the market will rise or fall and to position accordingly. Buy before it rises, sell before it falls. If you could do this consistently, you would become extraordinarily wealthy. The problem is that you cannot. No one can. Not consistently. The data is overwhelming. Studies show that the vast majority of market timers underperform a simple buy and hold strategy. Why? Because timing requires you to be right twice, when to get out and when to get back in. Miss either decision by even a small margin and your returns suffer. The market's best days are often clustered with its worst days. If you are out of the market trying to avoid the bad days, you often miss the good days as well. This does not mean you should never adjust your portfolio. Rebalancing is a form of timing, but it is mechanical, not predictive. You are not trying to forecast the future. You are simply maintaining a target allocation that is sustainable. Trying to predict market tops and bottoms is not. A better approach is to focus on valuation, not timing. When assets are expensive relative to historical norms, reduce exposure. When they are cheap, increase exposure. This is not market timing in the traditional sense. It is probabilistic positioning. You are not saying the market will crash tomorrow. You are saying that when valuations are stretched, the probability of poor future returns is higher. Act accordingly. Let me now turn to the concept of diversification, because this is one of the most misunderstood principles in investing. Most people think diversification means holding many stocks. That is incomplete. True diversification means holding assets that respond to different drivers. If all your stocks are in the same sector, or if they all rise and fall with the same economic factor, you are not diversified. You are concentrated. The goal of diversification is to reduce the volatility of your portfolio without sacrificing expected return. This is possible because assets that are uncorrelated or negatively correlated can offset each other's fluctuations. When one falls, another may rise, smoothing out the overall return. But diversification is not free. It reduces your upside as well as your downside. If you hold CN stocks, your best performing stock will have less impact on your portfolio than if you held 10 stocks. This is the trade-off. You give up some potential upside in exchange for lower volatility. Whether that trade-off is worth it depends on your goals and your tolerance for risk. For most investors, broad diversification is the right choice. It reduces the risk of catastrophic loss from a single position. It also reduces the need for constant monitoring and rebalancing. The diversified portfolio is more forgiving of mistakes because no single mistake can destroy you. Let me now discuss the importance of having a written investment policy. Most investors do not have one. They make decisions ad hoc based on how they feel at the moment. This is a recipe for inconsistency and poor results. Written investment policy forces you to articulate your goals, your risk tolerance, your time horizon, and your strategy. It serves as a contract with yourself, a commitment to follow a disciplined process. Your investment policy should include the following elements. First, your target allocation across asset classes. Second, your rebalancing rules. Third, your rules for adding or withdrawing capital. Fourth, your rules for evaluating performance. Fifth, your rules for when and how to adjust the policy itself. Once you have written this policy, follow it. Do not deviate unless there is a compelling reason based on new information or a change in your circumstances. Having a written policy also helps you avoid emotional decisions. When the market is crashing and your instinct is to sell, you can refer to your policy. It will remind you that market crashes are expected, that they are part of the plan, and that your strategy is to rebalance into them, not to flee. This external anchor can be the difference between success and failure. Now let me address a topic that is often avoided, the role of luck. Luck plays a larger role in investing outcomes than most people want to admit. Even the best system, executed flawlessly, can have periods of poor performance due to bad luck. Conversely, a poor system can have periods of good performance due to good luck. The challenge is distinguishing skill from luck. The way to do this is through sample size. A single trade tells you nothing, 10 trades tell you a little. 1,000 trades tell you a lot. Over a large sample, luck averages out and skill dominates. This is why professional investors focus on process, not outcomes. They know that a good process will lead to good outcomes over time, but that any single outcome is dominated by noise. For individual investors, this means being patient. Do not judge your system based on 1 year or even 5 years. Judge it over multiple market cycles, and even then, be humble. The market is complex, and there's always more that you do not know than you do know. Let me now turn to the concept of opportunity cost. Every decision you make has an opportunity cost, the value of the next best alternative you did not choose. If you invest in asset A, you cannot invest that same capital in asset B. This is obvious, but it has profound implications. It means that holding cash while it earns a low return has an opportunity cost, but so does being fully invested. If you are fully invested and a better opportunity arises, you cannot take advantage of it without selling something else. The optimal allocation is the one that balances these trade-offs. It maintains enough liquidity to act on opportunities while keeping enough invested to benefit from market appreciation. There is no single right answer. It depends on the current market environment, your edge, and your time horizon. But the principle is clear. Optionality has value. Do not give it away lightly. Another principle that is often ignored is the importance of consistency. Consistency in process, in discipline, in execution. Most investors are inconsistent. They follow a system for a while, then abandon it when it stops working. They rebalance religiously, then skip a rebalancing period because the market is doing well. This inconsistency destroys their edge. The system does not work if you do not follow it. Consistency is difficult because it requires ignoring short-term feedback. The market will tell you that you are wrong. It will tell you that your system is broken. It will tempt you to change. But if your system is based on sound principles, if it has been tested and validated, then the correct response is to stay the course. The market's feedback is noise. Your system is signal. Let me now address the role of inflation in long-term investing. Inflation is the silent thief. It erodes purchasing power gradually, almost imperceptibly. A 3% annual inflation rate does not sound like much, but over 20 years, it reduces the value of a dollar by more than half. This means that nominal returns are not what matter. What matters is real returns, returns after inflation. Most investors focus on nominal returns. They celebrate a 7% annual gain without realizing that if inflation was 4%, their real gain was only 3% over a long time. Origins, this difference is enormous. A 7% nominal return compounded over 30 years turns $1 into $7.61. A 3% the real return turns $1 into $2 43. The difference is dramatic. This is why protecting against inflation is so important. Real assets, commodities, real estate, inflation-protected securities, these are the tools. They may not outperform in the short term, but over the long term, they preserve purchasing power. And preserving purchasing power is what long-term investing is really about. Let me now discuss the concept of survivorship bias. Survivorship bias occurs when we focus on the winners and ignore the losers. We read about the investors who made billions and assume their strategies are the key to success. But we do not read about the thousands of investors who used similar strategies and failed. This creates a distorted view of reality. The same applies to investment strategies. A strategy that worked in the past may have worked because of luck, not skill. If you only look at strategies that survived, you are ignoring all the strategies that failed. This makes it seem like success is more common than it actually is. The antidote is to evaluate strategies based on their theoretical foundation and their robustness, not just their historical performance. Ask, does this make sense? Is it based on a principle that is likely to persist? Is it robust to different market environments? If the answer is yes, then the strategy is worth considering. If the answer is no, then historical performance is likely noise. Now let us turn to the concept of scenario analysis. A scenario analysis is the process of evaluating how your portfolio would perform under different future states of the world. It is not prediction, it is preparation. You identify plausible scenarios, rising rates, falling rates, high inflation, low inflation, economic boom, economic bust, and you assess how your portfolio would behave in each. This allows you to identify vulnerabilities. Maybe your portfolio performs well in most scenarios, but collapses in one specific scenario. If that scenario is plausible, you need to adjust. Maybe you add a hedge, or you reduce exposure to the vulnerable asset, or you increase your liquidity buffer. The goal is not to be prepared for every possible scenario. That is impossible. The goal is to be prepared for the scenarios that would hurt you the most. Let me now address the concept of mean reversion. Mean reversion is the tendency of prices to return to their long-term average. If an asset is trading above its historical average, it is more likely to fall. If it is trading below, it is more likely to rise. This is not a law, it is a tendency. But it is a tendency that has held across many assets in many time periods. The reason mean reversion works is that prices are driven by two forces, fundamentals and sentiment. Sentiment can push prices away from fundamentals in the short term, but fundamentals reassert themselves over time. When an asset is overvalued, future returns are lower because the price has already anticipated future growth. When an asset is undervalued, future returns are higher because the price has not yet reflected its true value. A disciplined investor uses mean reversion as a guide. When valuations are stretched, reduce exposure. When valuations are depressed, increase exposure. This is not market timing. It is probabilistic positioning based on a principle that has been validated over decades. Let me now turn to the concept of leverage again, but from a different angle. Leverage is often misunderstood. People think of it as borrowing money to invest. But leverage can also be implicit. If you hold a concentrated portfolio, you are using implicit leverage. You are betting heavily on a small number of outcomes. If one of those outcomes goes wrong, your portfolio suffers disproportionately. The antidote is diversification, which reduces implicit leverage. By spreading your bets across many assets, you reduce the impact of any single loss. This is leverage in reverse. Instead of amplifying risk, you are diffusing it. And diffusing risk is one of the most effective ways to improve long-term outcomes. Now let me discuss the importance of simplicity. Many investors believe that complexity is a sign of sophistication. They build elaborate models with dozens of variables. They chase esoteric strategies that require constant monitoring. But complexity is often a liability. It increases the chances of error. It makes the system harder to understand and harder to execute. A simple system is easier to follow, easier to validate, and more robust. If you cannot explain your strategy in a few sentences, it is probably too complex. Simplicity does not mean simplistic. It means focusing on the variables that matter and ignoring the rest. It means building a system that is understandable, executable, and resilient. Let me now address the role of fees one more time because it is so important. Every dollar you pay in fees is a dollar that is not compounding. Over long time horizons, fees are one of the largest determinants of net returns. A 1% annual fee reduces your terminal wealth by roughly 25% over 20 years. A 2% fee reduces it by roughly 25%. These are not small numbers. The solution is to minimize fees wherever possible. Use low-cost index funds. Avoid high-fee active managers unless they have a proven, repeatable edge. Minimize trading to reduce transaction costs. These are simple, mechanical steps that can add enormous value over time. Now let us turn to the concept of behavioral finance. Behavioral finance studies how psychological biases affect investment decisions. These biases, overconfidence, loss aversion, recency bias, herding, are hardwired into our brains. They evolved to help us survive in a different environment, but they hurt us in financial markets. The key insight is that you cannot eliminate these biases. You can only mitigate them. The way to mitigate them is through system and discipline. Write down your rules in advance. Follow them mechanically. Remove discretion wherever possible. This does not make you a robot. It makes you rational, and rationality over time is rewarded. Let me now discuss the concept of attribution analysis. Attribution analysis is the process of breaking down your returns to understand what drove them. Was it asset allocation, security selection, market timing, or luck? This is critical because it tells you whether your edge is real or imagined. If your outperformance is driven by asset allocation, then focus on asset allocation. If it is driven by security selection, then focus on security selection. If it is driven by luck, then recognize that and do not mistake it for skill. This kind of honest self-assessment is rare, but it is essential for long-term success. Now let me address the concept of asymmetric bets. An asymmetric bet is one where the potential upside is much larger than the potential downside. These are the bets that drive long-term wealth creation. You do not need to be right often. You just need to be right when it matters. For example, holding a diversified portfolio with a liquidity buffer is an asymmetric bet. The downside is limited because you are diversified and you have cash to deploy during crashes. The upside is unlimited because you can take advantage of dislocations. This is the essence of intelligent investing. Structure your portfolio so that you benefit disproportionately from favorable outcomes while limiting your exposure to unfavorable ones. Let me now turn to the concept of drawdowns. A drawdown is the decline from a peak to a trough. It measures how much you can lose before you recover. Maximum drawdown is one of the most important risk metrics because it tells you how much pain you will have to endure. Most investors focus on average returns and ignore drawdowns. This is a mistake. A strategy that earns 15% per year on average, but has a 60% maximum drawdown is riskier than a strategy that earns 10% per year with a 20% maximum drawdown. Why? Because the first strategy will force you to experience severe psychological pain, and pain leads to mistakes. You will be tempted to abandon the strategy at the worst possible time. A disciplined investor designs their system to limit maximum drawdown. This does not mean avoiding risk. It means managing risk. It means using diversification, liquidity buffers, and position sizing to ensure that drawdowns are tolerable. If you can tolerate the drawdowns, you can stay in the game. And staying in the game is what matters. Now let me discuss the importance of independence. The crowd is almost always wrong at extremes. When everyone is bullish, the market is usually near a top. When everyone is bearish, the market is usually near a bottom. This is not a paradox. It is a feature of human behavior. People extrapolate recent trends into the future. They buy what has been going up and sell what has been going down. A disciplined investor does the opposite. When the crowd is euphoric, reduce exposure. When the crowd is in panic, increase exposure. This requires independence, the ability to think for yourself, and to act contrary to the prevailing sentiment. It is uncomfortable, it feels wrong, but it is correct. Independence also means ignoring noise. The financial media is designed to generate attention, not insight. The headlines are sensational, the commentary is emotional. None of it helps you make better decisions. In fact, it usually makes your decisions worse because it triggers your biases. The solution is to turn off the noise, stop watching financial television, stop reading market commentary, focus on your system, follow your rules, trust your process. The noise will always be there, but you do not have to listen to it. Let me now turn to the concept of margin of safety. Margin of safety is the difference between an asset's price and its intrinsic value. The larger the margin of safety, the less risk you are taking. If you buy an asset worth $100 for $50, you have a large margin of safety. Even if your estimate of intrinsic value is wrong, you are unlikely to lose money. If you buy the same asset for $95, you have almost no margin of safety. A small error in your estimate can lead to a loss. A disciplined investor demands a margin of safety. This does not mean waiting for assets to be cheap. It means only buying when the price is significantly below your estimate of value. This reduces risk and increases expected return. It is one of the most powerful concepts in investing, yet most investors ignore it. Now let me discuss the concept of convexity. Convexity refers to the non-linear relationship between an asset's price and its underlying drivers. An asset with positive convexity benefits disproportionately from favorable moves and suffers less from unfavorable moves. An asset with negative convexity does the opposite. Options are a classic example. A call option has positive convexity. If the stock rises, the option value increases exponentially. If the stock falls, the option value declines, but only to zero. The downside is capped. The upside is unlimited. This is asymmetric. A disciplined portfolio seeks positive convexity wherever possible. This means structuring positions so that you benefit more from good outcomes than you suffer from bad outcomes. It means avoiding positions with negative convexity, where a small adverse move can lead to a large loss. Let me now address the concept of time diversification. Time diversification is the idea that risk decreases as your time horizon increases. Over short time horizons, volatility dominates. Over long time horizons, fundamentals dominate. This means that if you have a long time horizon, you can afford to take more risk because you have time to recover from adverse outcomes. But time diversification is not a free lunch. It assumes that markets are mean reverting, which is generally true, but not always. It also assumes that you will not need the capital in the short term, which requires discipline. If you are forced to sell during a drawdown because you need the money, time diversification does not help you. A disciplined investor uses time diversification to their advantage. They hold risky assets for the long term, knowing that short-term volatility is noise. But they also maintain a liquidity buffer to ensure they are never forced to sell at an inopportune time. Now, let me turn to the concept of factor investing. Factor investing is the process of targeting specific drivers of return, value, momentum, quality, size. Each factor has been shown to generate excess returns over long time horizons. By building a portfolio that systematically tilts toward these factors, you can improve your expected return without increasing risk. But factor investing is not magic. Factors go through long periods of underperformance. If you cannot tolerate those periods, you will abandon the strategy before it pays off. This is why discipline is so important. You must believe in the underlying principle and commit to it for the long term. Let me now discuss the concept of reversion to fundamentals. Over the long term, prices revert to fundamentals. A company that generates cash flow will eventually be valued correctly. A currency that is being debased will eventually lose value. A commodity that is in short supply will eventually rise in price. This is not prediction, it is probability. The challenge is timing. Fundamentals can take years to reassert themselves. In the short term, sentiment, liquidity, and technical factors dominate. A disciplined investor does not try to time the reversion. They simply position themselves to benefit when it occurs. They buy undervalued assets and hold them until they are fairly valued or overvalued. Then they sell and repeat the process. Now let me address the concept of stress testing. Stress testing is the process of evaluating how your portfolio would perform under extreme scenarios. A market crash, a currency collapse, a spike in inflation, a deflationary spiral. By stress testing, you identify vulnerabilities and adjust your portfolio to reduce them. Stress testing is not about predicting the future. It is about preparing for it. If your portfolio collapses in a specific scenario, and that scenario is plausible, you need to adjust. Maybe you add a hedge, or you reduce leverage, or you increase your liquidity buffer. The goal is to ensure that you survive all plausible scenarios, even if you do not thrive in all of them. Let me now turn to the concept of position sizing. Position sizing is the process of determining how much capital to allocate to each investment. It is one of the most important decisions you make, yet most investors do it haphazardly. They buy what feels right, what looks cheap, what is in the news. This is not a system. It is gambling. A disciplined investor sizes positions based on expected value and risk. If an investment has a high expected value and low risk, allocate more capital. If it has a low expected value or high risk, allocate less. This is the Kelly criterion in action. It is the mathematically optimal way to size positions over time, but the Kelly criterion assumes you know the probabilities, which you do not. So, conservative approach is to use a fraction of the Kelly size, say half. This reduces risk while still capturing most of the upside. Over time, this disciplined approach to position sizing can dramatically improve your results. Let me now discuss the importance of patience. Patience is one of the most underrated virtues in investing. Most investors are impatient. They want results now. They trade frequently, chasing short-term gains. But the best opportunities require patience. You must wait for the right setup, the right price, the right moment to act, and then you must wait for the outcome to play out. This is difficult because patience feels like inaction. It feels like you are not doing anything. But patience is active. It is the discipline to wait for high probability opportunities and to avoid low probability ones. It is the recognition that doing nothing is often the best decision. Now let me address the concept of humility. Humility is the recognition that you do not know everything, that the market is complex, that the future is uncertain, that your edge, if you have one, is small. Humility prevents overconfidence. It keeps you disciplined. It reminds you to stick to your system and to avoid taking excessive risk. Most investors lack humility. They believe they can predict the future. They believe they are smarter than the market. This belief leads to mistakes, to concentrated positions, to excessive leverage, to ruin. Humble investor knows that they cannot predict the future. They can only position themselves to benefit from a range of outcomes. And that is enough. Let me now turn to the final principle, consistency of process. The process is what you control. The outcome is what the market delivers. A good process does not guarantee a good outcome in the short term, but over the long term, a good process will lead to good outcomes. This is the law of large numbers. A disciplined investor focuses on process, not outcomes. They evaluate their decisions based on whether they followed their system, not on whether they made money. This removes the emotional roller coaster of short-term results. It allows you to stay calm during drawdowns and humble during winning streaks. In closing, let me summarize. Before you invest another dollar, build a system. Define risk mathematically. Diversify across assets and assumptions. Execute without emotion. Maintain a liquidity buffer. Rebalance systematically. Minimize fees and taxes. Accept that you cannot predict the future. Position yourself to survive all plausible scenarios and to benefit from some. Be patient. Be humble. Be consistent. This is not glamorous. It is not exciting, but it works. Over decades, it compounds into wealth. And that is what investing is really about. Not getting rich quickly, not beating the market every year, but surviving long enough for compounding to do its work. The market is a probability machine. Treat it as such. Build a system that respects probability. Follow it without deviation, and you will be among the small minority who succeed. Remember, this content is educational and not financial advice. Its purpose is to help you think from a quantitative and mathematical perspective. The principles I have outlined are not secrets. They are well known. The difference is that most investors do not follow them. They let emotion override logic. They let short-term noise distract them from long-term fundamentals. Do not make that mistake. Build your system, follow it, and let mathematics do the rest.